Atocha Global Analytics. Please like and subscribe. I wish to remind you, Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. Well, welcome back to Forecast Friday. This is our once weekly segment, and this is the Friday, August 25th, 2023 edition. And here comes the latest dose of reality, unlike most of the Republicans in Wednesday night's debate. So the reality, we had a surprisingly, actually shockingly high number in a data release last week, and this week see that things are actually slowing in the U.S. So why are these data points seemingly conflicting? Why is the overseas data looking so much worse than ours? And why is their data regarding U.S. looking worse than what we get here at home? So we'll cover some of that today. Now, there are some overseas items we need to cover, but let's cover the domestic items first. All right. So first, we have some things that are a bit perplexing. I covered this big jump to the upside in the Philly Fed Manufacturing Index, which had been struggling since 2022, really. And I'd included the following graph highlighting this stunning upward reversal. As I noted previously, this was either a miracle or this was bad data. Repeating what I noted then, this move up or any move up in this index would not and should not change direction to the extent that this data did. A modest improvement over a few months and then a jump is reasonable, maybe a reversal to a limited degree, but not this radical shift, especially when nothing materially really has changed in the interim. So, however, a noteworthy release this week, which we monitor, but we don't typically include in our metric tables, it shows that the U.S. and the global economy are continuing to soften. So, highlighting this, yes, but let's show what the rest of the world is seeing. And so we contrast that aberration with what we got this week from SP Global. S&P Global, they do a PMI flash index for the U.S. and Europe and some other different national or regional areas. So this is a kind of a leading edge snapshot of activity, and it can be and often is revised slightly later on in the month, typically when they have finished collecting their data and that sort of thing. So. Just as a note, the revisions are usually no more than 1 or 2 tenths of a point. So these are probably pretty close. But 1 or 2 tenths of a point, that's not a real big move, as you'll see. So let's look at the recent moves in the 4 reported areas here, and that's the U.S., the U.K., the Eurozone as a whole, and Germany in specific. So here's an overview graph of the 4 areas reported. They're generally moving similarly. They're all in concert. All crested and turned downward earlier this year. They've continued to weaken through the latest data. The Eurozone as a whole likely has been pulled down by Germany as it looks, as the yellow line depicting Germany here really shows quite the slide. While the UK also shows, a comparable softening, the Eurozone as a whole seems to be holding up a little bit better than those two. Of course, UK, Brexit, there's that whole factor too. But anyway, please know that Germany was the highest of everything in the March, and now it's down to the lowest of the 4 as it's depicted here. So that's a noteworthy change. Just to highlight the baseline of these numbers, it's 50. And above 50 is expansion, below 50 is contraction. So the U.S. is at 50.4. It had been increasing into May, which was about 54.5, and then it started down. So we're still above 50 technically at 50.4, but the trend is not our friend right now. However, it is also a 3-month trend, and the U.S. is not alone. So the UK went below 50 this month. So while they're battling inflation, teetering on the precipice of a recession over there, and with these trends, it really looks like everything has begun contracting there in earnest. The Eurozone as a whole is -2 and has been really about a month longer, since July is when it turned down. Now, Germany had typically been the strongest in the EU for over a decade and was positive even when the rest of the EU turned negative on the GDP last year and what have you. but that strength seems to have really waned, as you can see. I highlighted that they started at the top of the graph, or the strongest of these four shown, including being stronger than the U.S., and now they're the weakest. They were consistent with the EU in July, but now they've cratered downward by nearly 4 points to 44.7. That's well into contraction territory. Now, just to highlight, these are composites. That means there's other things that are included or combined into them to give you a composite. So they categorize S&P Global, they categorize within the respective economic areas to see what's going on a little bit more concisely. So let's look at what's going on there a little bit more closely so you can see what's going on. But before I show you the breakdown specifically for Germany, please like, subscribe, and ring that notification bell. So here's the mess in Germany right now. It's above 50 in business services. But the manufacturing related areas here have cratered well into recessionary territory. This is not good. 39.7 and 39.1 are both well below 50. Though they are flattening out over the last month or so, it is likely that the composite PMI and the Germany economy as a whole will be pulled underwater into outright recession if they haven't been already. As the largest European economy, as goes Germany, so will likely go the rest of the EU. So that puts that in context. I highlight this Eurocentric data and how it correlates with trends here as we have pressures from the EU and China, both weighing on global growth, and in some form or fashion, it does impact us here. If we are stressed here in the U.S., if our economy is stressed in some way, this adds to that stress. However, as you know, China could go, China actually could go through a depression, and it's not necessarily guaranteed to seriously impact us here. We may not have a recession because of that. Even if both the EU and China go negative, it's still not really guaranteed to drive us into a recession either. But, I look at it this way. After the recent post-lockdown recovery of the economy in the U.S., we're kind of like a surgical patient right now. Our wounds are still healing. The low interest rates and the stimulus were medicine during the worst of the economic melees after the onset of the pandemic. And now our real estate market is strained and distorted while we're grappling with the impact of an inflation surge afterward. So the medicine we're taking now is in the form of higher interest rates, which, has our immune system weakened. And we are quite vulnerable to infection right now. So, to put it all in kind of a medical analogy, that's how I see things. So that is my concern. It's not that an imminent threat of direct contagion from either Europe or China, but more of an infection that worsens our condition while we are vulnerable. So, anyway, the EU has these signs of a really noteworthy economic sniffle happening, and so and we're right, just according to the PMI index, we're just a little above water. So next, let's shoot around the globe to where another patient is a bit more critical. But before we go there, and I show you what's down with the ROC, please like, subscribe, and ring the notification bell. So here's two sentences that anecdotally really exemplify why China's economy is shocking everyone right now and why the media is suddenly covering it. Some of us, we saw this months ago, or actually even years before now, because the momentum was so hot even during the extended lockdowns in China. However, the entire Western media has now suddenly noticed that China is in a very bad way. These two sentences from an article entitled "China's Economy is Worse Now Than in the 70s," this analyst says, this covers why the media finally started covering it. This data point will shock you. Here it is. The property sector, which holds 70% of Chinese households' wealth, is ailing. Existing home prices slid 9% month over month in big cities in July, the steepest decline in a decade. So envision this. If the value of your house went down 9% in 1 month, would you feel confident to go buy a car, a new refrigerator, or go out to eat a little more often? It's pretty doubtful, right? So having lived through a time when house prices were going down about 1% to 2% per month, Here in the U.S., it was not a time frame when people really felt financially confident, let's just say. There wasn't panic in the streets or anything like that, but the typical homeowner was more conservative. Well, a 9% drop month over month would radically change people's behavior here. And that's what it's doing in the ROC. Again, that's month over month. That's not year over year. If that kind of rate continued for 1 year, the value would essentially be wiped out for those properties. So the actions by Chinese consumers, they're perfectly understandable if they're pulling back and saving more. People saying China is in a depression may not be wrong, but we can't definitively say that yet. But it could be, especially if this continues another month or two, that would radically shift people's behavior for an extended period of time. Okay, we've covered the news on that. We'll keep watching the ROC and the things like the S&P Global PMI indexes for Europe and here. We'll note when we see reason to be concerned, like we did this week. But anyway, we're going to move on. And with that, let's get to the metric table. So here's what we have on the metric tables this week. The Baltic Exchange Dry Index is back down a bit. We had a nice quarterly change. We've seen some improvement in recent weeks, but it's dropped back down. Same with the Drewry. It's dropped down a bit as well. The China Containerized Freight Index, weekly it's been moving up generally, but you can see Europe and the Eastern U.S. is back down a bit. We're still down quarterly. It still has some issues. Freight waves completely flat this week, exactly the same, completely unchanged. The retail sales we actually covered last week. The 10-year Treasury spread, it's back up. The percentage is a little off because I track it earlier in the week, but it's actually up a bit more. The spread has widened a bit more, I should say, at 0.78. And it is trending in that direction all week. All right, moving on to the second panel, the cardboard box index. Wow, I had to show you this. This is shocking, a huge drop. That dovetails, of course, with freight recession and trade recession and other things that we have. As it appears we have a rolling recession. Certain segments of the economy are impacted while other segments have not been. But the cardboard box, showing you the graph here, month after month, it's been higher. All of a sudden, it just cratered this month. So, the strong first half is weakening in the second half. I remind you that the conference board had forecast a recession to start in the U.S. this quarter, and these first set of numbers coming out, because this is actually for July. It's older data. It takes until the latter part of August to report July's. So it is looking like things are weakening, and cardboard box definitely shows a huge weakening here. But the initial jobless claims down another 10,000 even, and so that's an improvement of about 4%. Mortgage delinquency and mortgage foreclosure stats continue to move a little bit, and it is something that we're seeing it sneak up. It's not skyrocketing or anything, but it is sneaking up a little bit, and that is a little bit of a negative. The Conference Board Leading Economic Indicator Index, it's off a little bit. Again, slow movement, but we're down. It's a long-term trend of moving down. Chicago Fed Survey of Economic Conditions introduced you guys to this last month. This is great. It's got a lot of sub-indexes, which I watch for highlights. I'm just reporting the main composite number, and it is down. It's down 6.9, and you can see that it's been moving steadily down. Equipment leasing and finance, it's popped a little bit. It looks positive. It's actually, they use a 50-50 model like a lot of indexes. So above 50 is positive, above 50 or below 50 ends up being contractionary or possibly recessionary. They show a little bit of expansion at 50.4, but it's up 4% from a low last month. So the Chicago Fed National Activity Index, this swings wildly, so I usually don't really care about the most recent number, the monthly number, but you can see quarterly it's down a little bit, annually it's down a little bit, and that's averaged out. So that is just a one-time blip. If it ends up 2 or 3 or 4 times in a row, obviously the quarterly and the annual numbers will change. All right, moving on to the third panel, well down there to the G20 Mature Economies Coincident Leading Economic Index. You can see we had a good quarter over quarter after a nominal or down on annual, but then we've had a significant move down recently here. So this is something that's trending to factor, but the U.S. Coincident Leading Economic Indicator. Now, this is supposed to be kind of in front of a lot of the other indicators. It's showing good all the way across the board. A little bit of a movement in the most recent period. Well, again, we're going to keep an eye on this. So that finishes our tables this week, and a much bigger week this week on the metric tables. More news, and some of it was shocking. But by the way, before I wrap this up, please like, subscribe, ring that notification bell to keep the algorithms primed. And thanks again on that. But also a reminder, if you believe something is worthy of being on this list, please suggest it in the comments. Thanks again for sharing this journey. And until next time, ciao. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.